Welcome everyone to Financial Foundations Understanding the Building Blocks of Wealth. I'm your host, and I'm super excited about this new series. We're going to be diving into the core concepts that really underpin successful investing in financial planning, right?
Exactly. I think this series is going to be incredibly valuable. We're aiming to demystify some of these seemingly complex topics, breaking them down into easy to understand segments, one building block at a time, so to speak.
Absolutely. And today we're kicking things off with a big one, asset allocation. So let's get right to it. What exactly is asset allocation?
Well, in simple terms, asset allocation is all about dividing your investment portfolio among different asset classes like stocks, bonds, and cash. It's about finding the right balance between risk and potential reward, taking into account your personal financial goals, how much risk you're comfortable with, and how long you plan to invest. I mean, your time horizon.
Okay, so it's not just throwing money at whatever looks good at the moment. It's more strategic than that, right?
Precisely. It's a key driver of how well your portfolio performs overall. Think of it like baking a cake. Asset allocation is your recipe, deciding how much flour, sugar, and eggs to use to get the best result. It's the foundational step before you even start thinking about which specific stocks or bonds to buy.
That makes sense. So, what's the deeper dive here? What makes asset allocation so important in the financial world?
Well, it's really at the heart of portfolio management. It's rooted in something called modern portfolio theory or MPT, which basically says that you can reduce risk by diversifying your investments across different asset classes that don't move in the same direction at the same time, low correlation asset classes.
Okay, diversification, got it. So, spreading things out to reduce the hit if one area tanks, right?
Exactly. And there are different types of asset allocation strategies. There's strategic asset allocation, which is a long term baseline approach, tactical asset allocation, which involves making short term adjustments based on market conditions, dynamic asset allocation, which is more actively managed, and target date allocation, which automatically becomes more conservative as you get closer to a specific date like retirement.
Wow, that's a lot. So, how does someone actually put this into practice? What's the process look like?
Well, first you need to figure out your goals, your time horizon, and your risk tolerance. Then you need to identify the different asset classes you can invest in and what their historical or expected risk and return characteristics are. Next, you decide on the percentages you want to allocate to each asset class to meet your specific needs, and then you select the investments within each asset class to implement your plan. Finally, you need to keep an eye on your portfolio and rebalance it back to your target percentages as the market changes.
Rebalancing? So, basically, adjusting things to stay on track?
Exactly. Like if your stock allocation grows too large because the market is doing well, you sell some stocks and buy more bonds to bring it back to your original plan. It's like a gardener pruning plants to keep them healthy and growing in the right direction.
Oh, okay, that makes sense. Can we get into some real world examples here?
Absolutely. Let's say we have two investors, both saving for retirement in 25 years. Investor A is aggressive and goes with 80% equities, 15% bonds, and 5% cash. Investor B is more moderate, choosing 60% equities, 35% bonds, and 5% cash.
All right, so high risk versus medium risk, basically.
Precisely. Now, think back to the COVID-19 pandemic. When the market initially crashed, investor A's portfolio would have taken a bigger hit because it was heavily weighted in stocks. But during the subsequent market recovery, investor A would have likely seen bigger gains than investor B. Investor B, on the other hand, would have experienced a smoother ride overall.
So it's a trade off, right? Higher highs, lower lows for the aggressive investor, and a more stable but potentially less lucrative path for the moderate one.
Exactly. And there was this famous study by Brinson, Hood, and B. Bauer that argued asset allocation drives over 90% of portfolio return variability. While the exact number is debated, the main point remains asset allocation is huge when it comes to portfolio risk and return. Disclaimer: we advise investors to check with certified experts before taking any investment decisions.
90%? Wow. So where does this really make an impact? And why should people care about all of this?
Well, for individual investors, it's all about aligning your investments with your long term financial goals, like retirement or funding your kids' education, while also managing the amount of risk you're taking. It helps you stay invested even when the market gets bumpy.
Stay the course, even when things get rough. Makes sense. What about bigger players like institutions?
For financial institutions, asset allocation is the cornerstone of how they manage money for their clients. Wealth managers, pension funds, even robo-advisors rely on it. And because these institutions manage so much money, their asset allocation decisions can actually influence market prices. A large fund shifting from bonds to stocks, for example, can push equity prices higher.
Okay, that's a pretty big ripple effect. So, where do we see asset allocation in action?
Everywhere. It's used to build diversified investment portfolios, to align investments with life goals in financial planning, and to manage portfolio volatility. Analysts use it to figure out where a portfolio's return came from, and financial firms design investment products like balanced funds and target date funds around asset allocation models.
So, if I'm understanding this correctly, you can measure a portfolio's return based on the initial asset allocation strategy versus the returns from specific investments within those asset classes?
Exactly. It helps you understand if your success came from picking great stocks or simply from having a good mix of assets in the first place, right?
Gotcha. What are some of the common misconceptions people have about asset allocation?
One big one is that it guarantees profits or prevents losses. That's just not true. It manages risk, but it can't eliminate it, especially during major market crashes. Think about the 2008 financial crisis. Almost everything went down except for super safe government bonds.
Right. It's risk management, not risk elimination. What else?
Another misconception is that asset allocation is the same thing as diversification. It's not. Asset allocation is a form of diversification, specifically diversification across different asset classes. But you also need to diversify within each asset class, owning stocks from different industries and countries.
So it's diversification on two levels, really, across asset classes and then within each class.
Precisely. And finally, people often think it's a set it and forget it strategy. You can't just set your asset allocation and ignore it. You need to rebalance your portfolio periodically to maintain your target percentages. And you also need to review your allocation whenever your circumstances change.
It is like gardening. If you don't prune and maintain, things get overgrown and out of control.
Exactly. Okay. So to wrap this all up, let's touch on some related terms. What else should people be aware of?
Sounds good. Let's connect some dots.
Well, we already talked about diversification, which is really the overarching principle. Asset allocation is the primary way to achieve it at the highest level. Then there's rebalancing, which is the process of buying and selling assets to get your portfolio back to its original target allocation. Think of asset allocation as the plan and rebalancing as the maintenance to keep you on track.
Okay, plan and maintenance. Got it. What about risk tolerance?
Risk tolerance is your ability and willingness to handle potential losses. It's a critical factor in determining your asset allocation. If you have a high risk tolerance, you can generally allocate more to growth assets like stocks.
Makes sense. High risk, high potential reward, right?
Exactly. And then there's modern portfolio theory, or MPT, which we mentioned earlier. It's the Nobel Prize winning theory that provides the mathematical framework for asset allocation. It shows you how to build portfolios that maximize your expected return for a given level of risk.
So MPT is the theory behind the practice. Got it. Anything else?
Yes, the Investment Policy Statement, or IPS. It's a formal document that outlines your investment goals, objectives, time horizon, risk tolerance, and the target asset allocation strategy. It's basically your investment roadmap, written down on paper.
So the IPS formalizes and documents the asset allocation plan. This has been really insightful. Thanks. This is a great foundation for our new series. If you're enjoying this content, don't forget to like, share, and subscribe to the channel. We've got a lot more coming your way.
My pleasure. Remember, asset allocation is a fundamental building block of wealth. Understanding it can really help you make better investment decisions. Now, what do you think? Is asset allocation really the most important investment decision? Or are there other factors that are just as critical? Let us know in the comments.